Okay, I'll call this audit committee meeting to order, and we've got 3 items. We will be reversing items 2 and 3, so we'll go 1, 3, and then 2 in terms of dealing with them today. We will start, of course, with our annual audited financial statements for 2018, and welcome our audit team forward. Start off by Sherry and then turn over to Matt from KPMG. Matt and team.
Great. I'm pleased to be here today to present the 2018 annual financial report. For some of you, this will be the first time you're hearing a presentation on the city's consolidated financial statements. The format of the presentation will be as follows. First, I will provide a brief background to allow for a better understanding of the consolidated financial statements, as these are significantly more complex than the operating results that were provided to Council in March. I will then provide a high-level overview of the city's financial condition. At this point, you will have a chance to ask questions about my presentation or the content of the annual financial report. After that, Matt Medic of KPMG will present the findings of their audit, and there will be an opportunity for you to ask any questions you may have about the audit itself. In March, you received report FIN 19-021. This presented the results for the year ended December 31st, 2018 for the tax-based operations and the city enterprises. The consolidated financial statements being presented today combine the results of the tax-based operations and the enterprise, in addition to local boards that must be consolidated, the city's capital activity, as well as the activity of the city's reserve funds. They also account for the 2 government business enterprises, Kitchener Power Corp and Kitchener Generation Corporation. Local boards that are consolidated include the Centre and the Square, Kitchener Public Library, Belmont Improvement Area, and Kitchener Downtown Improvement Area. There are 4 individual statements within the consolidated financial statements, plus a number of notes and schedules used to provide additional details. The statements are, first, the consolidated statement of financial position, which is often referred to as a balance sheet. Second, the consolidated statement of operations. This is commonly known as an income statement. Third, the statement of change in net financial assets, and last, the statement of cash flows. Explanations for significant variances in the 2018 consolidated financial results have been provided in the financial statement discussion and analysis section of the annual report starting on page 10. The statement of financial position is used to evaluate the city's ability to meet its financial obligations. It documents financial resources such as cash, investments, and amounts receivable from others. It also shows amounts the city owes to others, which are typically referred to as liabilities. And it shows the non-financial assets or items held for purposes of providing future services. At the bottom of this page, it presents the overall accumulated surplus for the city. The statement of operations reports the revenue collected by the city and the cost of providing municipal services and the resulting annual surplus. The statement of change in net financial assets explains the difference between the municipality's annual surplus and the change in net financial assets for the year. The statement of cash flow reports changes in cash and cash equivalents resulting from operating, capital, investing, and financing activities. It shows how the city financed its activities and met its cash requirements for the year. As alluded to earlier, the format of the financial report brought to Council on March 18th that showed the tax-based and enterprise operating results is significantly different than the format required for the annual audited consolidated financial statements. The next 2 slides are designed to help walk you through the difference in the annual surplus on the statement of operation in these consolidated financial statements compared to the operating results that were provided to you in March for the same time frame. The amount presented in March was approximately $7.1 million compared to $75.8 million presented today. The first contributor to the difference is the requirement to consolidate certain boards as mentioned on slide 3 and to record the change in investment in the government business enterprises, being Kitchener Power Corp and Kitchener Generation Corporation. The addition of these items is adding nearly $11 million to the surplus for the year. Further adjustments are then made to these combined results to have them reported in line with the standards set out by the Canadian Chartered Professional Accountants Public Sector Accounting Board, or PSAB. The largest adjustments required to comply with PSAB relate to the city's tangible capital assets, or TCA. The statement of operations includes the revenue streams that were used to fund the creation of the assets and the annual amortization of these assets over their useful lives. The expenses incurred to build or purchase the assets are excluded from the statement of operations, but are rather recorded as an asset on the statement of financial position. Transfers from operations to capital or reserve funds and transfers from capital and reserve funds are removed in the consolidation, as these are an expense to one fund and a revenue in another. Given the consolidated financial statements are adding all funds together, these expenses and revenues offset. Another significant PSAB adjustment involves the treatment of debt repayments. Both interest and principal are treated as an expense in the operating results, whereas PSAB only allows for expensing of the interest. Taking all of these items in consideration leads to the annual surplus as presented in the consolidated statements of $75.8 million. The accumulated surplus of $1.41 billion reported on the consolidated statement of financial position is not a surplus as you'd be used to hearing of in regards to operating results. These are not dollars available to be spent. They are a representation of past investments that the city has made that continue to provide benefit to the city going forward. This includes things like tangible capital assets, the investment in Kitchener Generation Corporation, and the reserve funds set aside for specific purposes. To clarify, investments in tangible capital assets makes up $1.19 billion of the overall $1.41 billion. This in turn is made up of thousands of individual assets that will continue to provide benefit to the city for a number of years. In the previous slides, we saw that the largest impacts on the surplus are those related to tangible capital assets. The net book value of TCA, which is total cost of assets less the accumulated amortization applied to date, has experienced moderate growth over the last 5 years. This trend is expected to continue as we are in a period where significant amounts of older infrastructure assets are being replaced with newer assets at a much higher cost. The key takeaway from this slide is that the net book value as a percentage of cost for all city assets has remained steady at around 69%. If this percentage was dropping significantly, it would suggest that the city should look into its asset renewal programs. Recently, Mr. Lautenbach came to a council strategic session and presented the facilities infrastructure gap. To link these two sessions together, I calculated the net book value as a percentage of cost for the building assets only over the 5-year span, and this ratio saw a decrease from 65% in 2014 down to 58% in 2018. Linear assets, on the other hand, saw an increase from 63% to 67% in the same time frame as a result of the ongoing WIP program. The next few slides will present a high-level overview of the financial condition of the city. Financial condition speaks to the city's ability to finance its operations on an ongoing basis, regardless of economic changes and changes in other environmental factors such as growth. The chart here displays the 5-year trend in the overall debt balances for the city, broken down between the various types of debt. The municipal debt continues to decrease from its peak of $112 million in 2013. 2013 was the last year new debt was taken on for the EDIF program. Debt balances are expected to decrease for the next number of years as the EDIF debt continues to be paid down. Council passed a consolidated reserve policy in 2012, which provides a framework for building up reserve balances and ensuring they are used as intended. The upcoming long-term financial plan for the city will highlight and review a number of the city's financial policies, including the reserve policy. This chart shows the 5-year trend in the consolidated reserve balances. This graph includes all reserve funds except those that are considered as obligatory reserve funds, which appear as a liability on the city's statement of financial position. As can be seen in the graph, the balance has been increasing since 2014. The next couple of slides will provide a bit more detail about the various types of reserves and their balances compared to their target levels. The 5 reserve fund categories shown on this slide are laid out in the reserve fund policy and are used during budget discussions. The top line of this chart shows the 2018 ending balances for each of the 5 reserve fund categories. The middle section shows the target ranges for the reserve categories and how well the reserves meet the minimum target. The bottom section shows the 2017 ending balances by reserve category and the change between 2017 and 2018. I would now like to draw your attention to the far right column, labeled Total Reserves. Here you can see that total ending reserve balances in 2018 were $72.5 million, which is 76% of the minimum target balance of $94.9 million. This ending reserve balance has grown 15% from $63.1 million at the end of 2017. This chart groups all similar reserves into one category and calculates the percentage of the minimum for the full category. Within a category, there are certain reserves that are funded above the minimum target that are offsetting those that are below their minimum target. To ensure every individual reserve met its minimum target balance, an additional $67.2 million would need to be injected into the reserve funds. Stabilization reserves and program-specific reserves have both seen significant increases in 2018. Unfortunately, capital and corporate reserves continue to be well below their recommended minimum targets. So, although there wasn't a significant draw on reserve balances in the current year, the city is open to significantly more risk than its reserve policy indicates is reasonable. This financial indicator provides an indication of how much money is set aside for future needs or contingencies. The Ministry of Municipal Affairs and Housing has recommended that municipalities in Ontario maintain a minimum of 20% of municipal expenses in reserves and reserve funds. The increases to the reserves over the last 5 years have helped bring the city close to this recommended minimum, but the city is well below the comparator municipalities. This graph combines the city debt and reserve positions together. Rating agencies consider it to be prudent to have a debt-to-reserve ratio of 1-to-1 or better, which means that the city would have $1 in reserve for every dollar in debt. It can be seen in the chart to the right. The listed comparative municipalities all hold more in reserves than they do in debt, with the exception of Waterloo and St. Catharines. The city's ratio is now better than that of Waterloo, but is about twice that of Cambridge. At the end of 2018, the city has $1.02 in debt for every dollar in reserves. This shows much improvement from 2013's $3 in debt for every dollar in reserve. The magnitude of the city's debt load can largely be attributed to Edith and was known before the approval of the program. The final financial measure to be presented today is also the most complete picture of the city's financial health. Financial position per capita is determined by subtracting total liabilities from total financial assets and dividing by the population. A positive ratio shows that the city has enough financial assets, things like cash, investments, and receivables, available to pay everything it owes to others, including its municipal debt. Looking at the chart to the right, the value of $888 in 2017 means that if all financial assets were converted to cash and all liabilities were paid out at the end of 2017, then there would be $888 per resident remaining. The City of Kitchener was very close to both the average and medians of this sample. Finally, as shown in the graph to the left, Kitchener has kept a fairly steady position over the past 5 years, which shows that even though debt levels have been high, the city is not in financial peril. The city's financial position has been steadily improving. It is a perfect time to focus on long-term financial planning in order to be able to continue with this trend. Limiting new debt issuances to what is already planned for in the 10-year capital forecast will allow debt levels to fall as the EDIF debt matures. Ongoing efforts to build reserve balances will enhance the financial position. Council is encouraged not to draw on existing balances for uses other than what the reserve was created for, and to continue making strides to see reserve levels brought up to at least their minimum targets. Continuing to hold long-term investments provides investment income and cash flows year over year and benefits the city's net asset position. A strong asset management program will help ensure the city has the capacity to provide ongoing services to our citizens. So that includes my portion of the presentation. I'd be happy to answer any questions council may have.
Okay, great, thank you. We do have some questions. So we'll start with you, Councillor Gazzola. Sorry, I didn't go through. Go ahead.
Yeah, I have a number of questions, and I'm not sure I'll get lost here because the numbers go all over the place. The numbers of your pages. I have one here, starting with 1.3. Yeah, 1.3 would be these, your financial overview, right? I was just, surplus has increased from 52.8 million to 75.8 million. Where do I see that? Am I right there? Or?
That's correct. It's at the bottom of 1-3.
Or on page 27 also, yeah. Yeah, 27 I can read. 1-3, my eyes are too old.
Sure, Councillor Gazzola, can you speak into the mic?
I'm sorry. Yeah, okay. What, can you account for that? What is, I guess actually I'm asking, we had budgeted for 53.5 surplus, we end up with 75.8. What's sounds great.
Through you, Mr. Chair, I have documented the various different explanations for each of the significant variances year over year, as well as the current year compared to budget for each of the revenue lines that were significant in each of the expense categories, as they were significant throughout the management discussion and analysis section, which starts on page 10 of the annual report, the color section at the front. There's many, many different factors that are contributing to that overall surplus compared to budget.
That is a humongous increase. Is there anything that should jump out at me, or?
Sorry, I've documented these quite some time ago, and now I'm just...
Well, okay.
But probably on, Councillor Gazzola, on page 1-9, I think, there's three obvious ones. Gasworks, which are up by almost 3 million, water, sewer, and stormwater, which is up by 3.5, and other, which is up by 3.
Okay, that's about 9 million. I'm looking for the other...
Sorry?
That's about 9 million. I'm looking for the other 13 million. We can come back to this, okay. Just a quick thing. On 1-14, you show a surplus of 1.4 million. Does that tie into page 1-12? It shows 1.7 million. Are they the same figure?
Sorry, on 1-12, that is the tax-supported surplus only.
Yes?
On 1-14, that's the accumulated surplus, which is all years combined, and that's actually 1.4 billion. So this one includes the things like tangible capital assets, et cetera.
Now, where did I miss that? 1.4, okay, it's in millions, okay. All right. Pages 121 to 124, there's four, are they different? Did I miss something there? Looked like all four pages were the same to me.
The slide is the same, it's just the highlighting for on-screen when we're presenting it to bring your attention to the total reserve column versus the bottom.
So I wasn't going crazy.
Yeah.
I wonder if you could just repeat again on 127 what the per capita financial position is again.
At the end of 2018, it's at the end of 2017, it's $888 per resident.
No, I understand, but it's calculated by taking,
Sure. It's total net financial assets, subtracting off the total liabilities, which includes our debt, and dividing that by the population.
Okay, on 138, we talk about employees' future benefits. We had an issue a number of years ago that had something to do with WISB and our actuaries' information, and during the year it came up and caused quite a concern. Has that been looked after?
We are continuing to see a forecast for the WSIB reserve being depleted over time. Council has injected $350,000 into that on an annual basis, but we are still projecting that by the end of 2023 that it will be into a deficit position.
Okay, so it is a problem that we're looking after then.
It will be an area that will need to be continually monitored so that we have the sufficient funds in order to make those payments in the future.
Councilor Guzzo, do you have more questions? Or?
Yeah, I do, yeah.
Okay, so I can ask you to ring in again. Councillor Singh, you're up next.
Thank you, Mr. Mayor. So a question on the asset to debt ratio. Does that include all our assets, including hydro as well, our investments?
Yes, it does.
Okay, all right. The other question I had is more focused on our reserves. Whereas right now we have about 72.4 million, while the minimum should be a target of 94.9. One of the slides that really kind of popped out a little bit for me was 1-25, which shows the reserves to expenses, and Kitchener seems to be at a lower position than a lot of the other peer municipalities in this ratio. Now, does that include expenses towards our gas utility as well?
Yes, it would be our entire consolidated expenses,
right.
So it will include our Gasworks enterprise.
So just to ensure that we're taking this information as a direct correlation to the municipalities, all the other municipalities except for Kitchener don't have, or don't. Well, Kitchener alone has the gas utilities. The other municipalities don't.
That's correct.
And if that were to be factored out, well, how would our position be at that case?
I would have to come back to the ratio. I didn't specifically calculate that.
That would be helpful. It's just that because that is a significant, and to be honest, even a consideration of our stormwater utility, where we are in the forefront, having initiated that utility, and I think others are still in the midst. Some have, while others are still in the midst of incorporating that into their structure. But those two play a factor, right, to get a clear picture of where we sit. Now, the other question, or last question I had is, when we look at a reserve, who establishes what that minimum and maximum threshold should be?
Through you, Mr. Chair, those were determined through a process with Council to develop the reserve policy in 2012, and those reserve minimum targets were a part of that overall policy review.
I see, okay. So it's not an outside body that outlines a certain minimums and maximum, it's our own internal perspective of where we should be financially with our reserves?
They are internally set, but there are a lot of industry norms that are used in order to present those minimum targets. In
Okay.
a lot of cases, not all, of course.
And in fairness, another municipality may not be as conservative, or do they follow a very similar practice? Because when we compare ourselves to our minimum maximum to the other municipalities on their reserves, so is there consistency?
As mentioned, there are a lot that do have an industry standard, and you will see those consistent across the board. You did also see that as a comparator, the City of Kitchener on the expense to reserve, again, not accounting for the removal of gas, is significantly lower than those others.
Okay. I would love to see where we would be with that factored out. Thanks.
Thanks, Councillor Singh. Councillor Davey.
Thank you. Pardon me, most of my questions have been asked. I'll move the recommendation as well. Mr. Mayor, just one question. On page 1-27, the financial position per capita, remind me again what this chart is showing us.
You will see in some municipalities, they actually have a financial deficit per capita. So in our case, the fact that we're positive, first off, is the biggest positive. It is taking all of the financial assets and subtracting off everything that the city owes to anyone else and finding the remainder and then dividing it by residents. So we do have things like our investment in Kitchener Power Corp that are increasing our assets. That is drawing that to be a significantly higher number.
So I can take this to mean that if we sold all of the assets that we had, this is the number that we'd have at the bottom, including hydro.
And this is at the values that they are included in our financial statements. It's not necessarily a fair market value of those assets.
That's what I was getting at. So how would you characterize the value, the fair market value versus the value in our statements, especially with items when it comes to hydro or gas utility?
Sorry, can I ask you to repeat the question?
Sure. With respect to how they're valued in valued here versus fair market value, how would staff recommend that? Is it an accurate assessment of the fair market value?
The way that the Kitchener Power Corp and Kitchener Generation Corporation are accounted for is on a modified equity basis. So that is essentially our holdings in shares and debt plus our share of net income each year since we took on that investment. So it doesn't necessarily represent a fair market value of the investment, and I couldn't attest to what that fair market value might be.
Okay, so you couldn't even indicate whether the fair market value would be higher or lower?
I honestly...
Okay, no, thank you.
Back to you, Councillor Gazzola.
Yeah, I'll start off by saying I would think that I was going to ask you that question, whether you had a ballpark figure of what the fair market value, especially of gas and hydro. I would expect that it's higher than what we carry on the books. That's just my opinion. Back to page 26, and it's 26 of the financial statements. Yeah. Okay, it's on the. There was. I'm sorry. Page 28. Can we go to page 28? There's some substantial changes at looking at the changes in net financial assets. The acquisition of tangible capital assets, we had budgeted for about 67 million, and actual is 122 million. What does that mean? Did we buy a lot more than we were expecting, or how do we understand that?
Sure. With regards to our tangible capital assets, it depends on the timing of spends in our capital program. So we may budget for an expense to happen in 2018 and the actual spend doesn't happen until 2019. Things like that will come into effect, as well as we get assets donated to the city, contributed to the city essentially, primarily from developers, and we have no control over the timing of those. So we did see a significant contribution by way of the developers in 2018 in comparison to 2017. Again, that wouldn't be factored into the budget for the 66 million.
Is there any explanation of that anywhere in the statement here?
We do talk about the contribution of tangible capital assets with regards to on page. On the revenue page. On page 18 of the management discussion and analysis, and we also do refer to it slightly in the tangible capital assets section about contributions, not specifically with regards to budget, but in comparison to prior year.
On, okay, a couple of questions just on 26 or 20, yeah, on 26, which is our consolidated financial position. There's a big jump in cash. Is there any explanation for that?
I will jump back
That's
to...
$20 million. Overnight, that would make a few dollars. So, is it?
And,
Is
yeah,
it-
it refers
is
to
it
the
just a-
statement of cash flow, unfortunately, which...
Okay. Is it just a timing difference?
Yes,
you're not carrying a lot more cash on the...
not on a regular basis in cash, it's just, it is timing, yes.
Okay. And the other thing that jumps at me is that the accounts payable have gone up quite a bit, from 76 million to 112 million. Is that another timing issue? We're not getting behind in what we should be doing.
No, you're correct. It is related to timing. Some significant payments to the region, slightly different timing this year versus last year, things like that.
Okay. Now, and the other, okay, thank you. Another question I was asking is the real value of our hydro and gas works. Is there any way that staff can look at that issue in the months ahead so that we know what we're talking about when people are talking about amalgamation? Is there any way we can try to put a finger on that? I guess I'm looking at Mr. Chapman.
Through the chair, as it relates to hydro, I believe that issue primarily rests with the Hydro Holding Corporation Board, and I believe they've done analysis over the years at the board level on that question, so I would look to current board members to comment. And as it relates to gas, we've done analysis on that in the past and shared that with council. We could certainly recirculate that information to council. The numbers would be inflated, but I don't think it would warrant going out to do new analysis at this point in time.
Is there any reason why something like that cannot be public?
There are reasons why strategically council may not want to share it publicly, but ultimately that would be a council decision to make.
I mean, people in the know, I'm sure, know what it would be worth. It's different if we were to be selling it or wanting to selling it immediately. But all right, I will leave that with you. Thank you. Thank you. That's all. Thank you.
Thank you, Councillor Gazzola. I guess we don't deal with the motion until after we hear from our auditors. So I think those are all the questions we have for you, Sherry.
Thanks.
So with that, we'll turn it over to our auditors. Welcome, Matt.
Thank you. And happy to be here. With me is Courtney Cheel. She's the senior manager on the account. And together we share responsibility for completing the audit of the financial statements and the related financial statements within. Just as a side note, both Court and I took the Ion to get here today. It was a nice, smooth ride. It was on time. And while this perhaps isn't the right forum for this, kudos to the driver. Because I stood right behind where the driver is, and there was a lot of stuff going on that she had to pay attention to, and that job, I'm positive, is a lot harder than it looks. So anyway, so praying that it doesn't rain this afternoon so we don't get wet heading back, but that's all good.
Well, great to hear. I know actually all of us were out on Friday, and some of us couldn't resist being out on Saturday and Sunday, taking rides at various points in the day, and it is pretty awesome.
Well, as a good accountant, I also appreciated the fact that there was no charge for me today directly, but as a resident of the region of Waterloo, I realize I'm paying for it eventually. So I just get to share it with 600,000 other people. Anyways, I digress. So in your agenda materials, you do have our audit findings report. Much of the audit findings report contains things that are required communications from the auditor to this committee, so I won't necessarily go through them in detail, but I will touch on the highlights as we move along. In the executive summary, we do make a couple of comments. We do note that there were no changes to the audit plan that we presented to this committee earlier in the process. And in terms of finalizing the audit, as Sherry mentioned, the financial statements are still in draft form. They do require approval by council prior to us being in a position to issue our audit opinion thereon. We had a handful of items when the report was prepared earlier in May that needed to be completed. Really at this stage we're just putting together the final correspondence and dotting the final I's and crossing the T's, but for all intents and purposes we are complete. In the draft financial statements there are copies of the draft audit opinions. In each of those cases those audit opinions are clean. They do not contain any qualifications, scope limitations or other modifications that would indicate it's not a clean opinion. So that is excellent. For those of you that are used to reading audit reports, you will note that the text of the audit report is significantly different this year than it would have been in the past. Fear not, we just have lots of good wordy people to increase the words and pages that those rely on. As we move into 2 slides down, onto page 34 from an audit risks and results perspective. When we did meet with this committee before, we did mention that it is our responsibility to consider the risk of fraud in the audit, and to remind the committee that when we consider that risk, that's the risk of the intentional manipulation of the accounting records through to the financial statements. To reiterate, it is not the risk that the city faces as a target or a victim of fraud from outside sources. We do believe that the risk of this is very low, but the auditor has to consider it in her work. Based on the work that we performed, we had 0 findings or 0 issues whatsoever to report. On the next page, we talk about the accounting for obligatory reserve fund revenue and deferred revenue. And for the most part, we're referring to development charges in this caption. So as you well know, development charges are collected and then used for specific projects in accordance with the development charge bylaw and the study that backgrounded it. So in terms of the risk here, we focus on it because we need to make sure that the revenue is recognized not at the time that the development charges are collected, but at the time that the development charge money is spent on the eligible products as per the study and the bylaw. So as a result, we did look at the controls around the recording of revenues and cash receipts and tested those controls. We looked at the continuity schedule of development charges and ensured that that was accurate. We looked at a sample of expenditures that were incurred during the year to make sure that they were development related, and we didn't have any issues or concerns in that matter. The next area of focus is the accounting for tangible capital assets. As was mentioned before, this is the largest single item on the city's financial statements. It is a very significant balance, and it does contain risks because if items are not accounted for correctly in this manner, it will have a significant impact on the ending surplus. So as a result, we tested a sample of additions and disposals of assets in fiscal 2018. We also reviewed expense accounts that might contain capital items to look for items that were otherwise not recorded as capital. And we also recalculated the amortization expense in accordance with the policies, and we assessed the reasonableness of those amortization policies. Again, no issues or findings. You will recall on the next slide the accounting for contaminated sites. So this is an accounting requirement that, in layman's terms, if you have site contamination on any properties that are not in active use, and there is a requirement to remediate that site contamination, a liability shall be recorded on your financial statements. A significant exercise was undertaken a few years ago to identify if this was the case, and we agreed that there were no such cases. And that continues to be the case today. I do want to mention, however, though, there is an upcoming accounting standards in a couple of years that deals with asset retirement obligations, which may include some properties that are currently scoped out of the contaminated site section and may result in liabilities being recorded. That standard is not applicable for another few years, and we're working with the team here to understand how that might be affected. I do want to make one final note on this page because it's a result of a question I've received in another similar session. We do say at the bottom of the page that we believe that management's process for identifying the estimates is considered adequate. Adequate from an auditor is a really, really good compliment. We only give adequate or inadequate. So I didn't want somebody to draw color from that it met the bare minimum and couldn't be better. It is a good process, so I want to reiterate that. I think the last slide that I have in this section deals with the accounting for employee future benefits, which does include the accounting for the WSIB obligation, as well as health and dental and for early retirees, as well as the sick leave plan. In accordance with the standards, we do rely on the work performed by the city's actuary in calculating these figures. However, we do check to make sure that the information that the actuary has is reasonable and complete. We do an assessment of the assumptions that are utilized, as well as we make sure that the accounting is done in accordance with the standard. And we had no issues or concerns there. In the conduct of our audit, we are increasing the scope of technology, including various data and analytics tools. This year, we rolled out a new tool whereby we can run routines that look at the cash collections throughout the year and see that they're applied against the appropriate accounts. We're happy that didn't yield any errors or deficiencies. And then my final comments come on the next slide in terms of the form, arrangement, and content of the statements. The overall presentation is considered appropriate for the size, scope, and segment of the organization, that being a large lower-tier municipality in the province of Ontario. So with that to the chair, I will conclude our formal comments, but happy to take any questions. Oh, and before I do that, sorry, one last thing. I want to thank Brenda, Roger, Sherry, and the whole finance team here. As usual, we got excellent cooperation throughout the audit. That's perfect.
Wonderful. Thank you very much for that. And I know when I met with you, you reiterated that the great team that we have here at the city that is involved in putting all of this together and getting it to you, and how that makes life easier and a cleaner audit. And I think it speaks volumes about the professionalism of our staff and the great job that I know that they do for us. So thank you for reiterating that here in the public session. Councillor Gazzola, some questions.
Yeah, I don't really. I just wanted to double check on the WSIB. I think you're well aware of it. Do you communicate with the actuaries every year, or is that something you do every few years?
We communicate with them every single year, yes.
Yeah. And from looking at everything is very clean. No problems that you encountered. It's difficult. Oh, the other concern I did have, it was on development charges. Looking at, we seem to be in a position with a lot of debit balances, I think, overall, but it's a timing issue. How much do you get into that, or are you satisfied with all the accounting on the development charges? Like there were times when municipalities sometimes overextended, and got themselves into a hole. We don't have that situation here.
I believe you are correct. Note 9 to the financial statements does contain some details, so I'm just going to flip to that quickly. So development charges at the end of the year is a credit balance of just under $16 million, which means you've collected $16 million more than you've spent on development-related activities in accordance with those charges that have been collected. Now, to the councillor's specific comments, there may be some individual pots that are in a debit balance, and that would generally mean for those types of development activity, you have spent the money before it's been collected. But as long as within the context of the entire bylaw, it stays in a credit balance, we're all good. Should the city spend in advance of collecting these items, it just means you wouldn't have a deferred revenue associated with them. You'd have zero balance until such time as those were collected. And I understand, paying for development-related project activities sometimes doesn't always follow the collection. In some cases, the city has to spend money up front on a development in order for the rest of the development to come on side and those permits being issued.
Okay. Thank you. At this point, I gather you've done all your work, and it's just a matter of council approving the financial statements.
That's correct.
You're not awaiting anything from anybody.
That's correct.
Okay, thank you.
Councillor Davey.
Thank you. Not a question, just wanted to speak, Matthew, for a second. If I recall correctly, we're dealing with the audit services with KPMG immediately following this. And if I recall from the documents, I believe it said that for, familiarity reasons or whatever, you might be cycling out. If this is going to be approved in the next couple of years, am I recalling correctly? I guess I'm questioning, is this the last time we're going to see you for a while?
So we do have, to answer quickly, yes. Should KPMG be appointed for fiscal 2019 and 20, my partner Tom Mennel will be the audit partner signing the accounts.
Okay, I understand. So I just wanted to say that I've really appreciated the work that you guys have done over the years, and maybe we'll see you. I'm not sure how often that cycles in and out when you're allowed to come back again, but I just want to say that we really appreciated it.
You're welcome. I get timed out for 2 years.
Timed out for 2 years. You're in the corner for 2 years. Okay. Thank you.
To the councillor's comments, professional standards require that an audit partner rotate off the account once they've been on it for a certain period of time. It provides for greater audit quality to ensure that any long-term associations are properly dealt with.
Okay, great. Thanks. Those are all the questions we have. And I too just want to thank you for all of your efforts and work as well, and look forward to working with seeing you on the ION.
Okay, thank you so much.
So with that, does somebody care to move the recommendation? Councillor Davey, any discussion? All those, actually, Audit Committee, I don't need a seconder. All those in favor? Opposed? That's carried. Okay, we'll now move on then to item number 3, and we'll turn it over to Karina.
All right, good afternoon, everyone. So, today I'm going to be talking about 3 status reports on audits that were previously conducted, including SAP User Access Separation of Duties Compliance Review, an Employees Expenses Controls and Compliance Review, and an org review of the Office of Mayor and Council. So also in progress at this time, as I'm sure you're aware, is the Development Services Review, which is looking at site plan and public engagement processes. So for all of the status updates that I'm about to present, the purpose of them is really to just check in with staff to ensure that they're addressing the audit findings in a timely manner and to identify any areas that have not seen significant progress and for which there may need additional support or senior leadership to move progress forward. As such, these are not re-audits of the topics, but rather just a check-in to see what the status of the recommendations is. So the first topic is the SAP separation of duties. The objective of the original audit was to examine SAP user access and determine if there were any scenarios where the combination of access rights would allow the user to create transactions within SAP that would allow them to steal from the corporation or to misrepresent the corporation's financial position. There was no evidence of fraud found through this review. However, there were several user IDs that had more access than was required. So recommendations of the original review focused on removing unnecessary access and implementing processes to periodically review user access. Of the original recommendations, 7 were implemented immediately. And the recommendation to create a process to reassess access requirements when employees change roles within the corporation is currently in progress. And the recommendation to create a process to annually review access has not been started, as it requires a number of custom reports that would take significant effort to develop. So this will be looked at as part of the SAP 5-year roadmap strategy, but in the meantime, they are carefully reviewing any new accesses that are being created. The benefit realized from this audit is that the identified separation of duties conflicts have been resolved, and therefore the potential for fraud has been significantly diminished. So there are no further follow-ups required on this particular audit and recommendations. However, this topic will remain on the list of periodic assurance audits for compliance testing. Are there any questions on this status update?
There are none.
All right, the next status update is related to employee expenses, which include any purchases of goods or services made by staff on behalf of the city in the course of their jobs that the city reimburses them for. So they can be purchased through a number of methods, including petty cash, the corporate visa, mileage and parking forms, etc. The original audit examined the controls around the various employee expense reimbursement processes and tested employee compliance with corporate policies through a sample of employee expenses. The findings were that the existing processes managed by the accounting division have sound controls and employee expenses related to legitimate city business with required backup to support the claims. There were no cases of fraud uncovered. The main recommendation from this review was to streamline the process for the employee by creating a consolidated policy and instructions where they can find not only the guidance on the policy itself, but also how to submit each type of expense for reimbursement. Of the original recommendations, all 16 that were assigned to the accounting division have been implemented. The one that has not been started is actually assigned to me and actually consists of the physical inventory of hardware. So during the expense audit, I found that a number of the employee expenses related to purchasing various IT hardware. Given that hardware can be stolen by staff, I was curious to know what procedures staff had to ensure that the purchased hardware made it to its final destination and how they controlled on-hand stock of common items. So due to other priorities, I have not started this audit yet, but I will add it to a future work plan. The main benefit from implementing the recommendations in this audit was that we are seeing an increased rate of completeness of expense claims and compliance with policy. This means less rework for both the employee and accounting staff and better controls. We now have a central place for the master policy and instructions that staff also have improved the automated controls on submission forms with checks to input checks and to verify if duplicate claims have been submitted. And a key component of the success of these items has been a rollout of employee expense training across the corporation, both in person and available via an online course. Similar to the SAP audit, there is no follow-up required on the recommendations of this audit, but the topic will remain on the list for periodic compliance testing. Are there any questions?
There are. Councillor Marsh.
Thank you. Karina, just curious if there's a timeline on, and if there's a sense of urgency about the technology hardware inventory.
It will likely go on next year's plan so that I don't forget about it.
Yeah, just curious. So that'll be, but now that you've reported back on the follow-up, I take it there's no additional follow-up to council, right? But you'll be following up directly with them in a year from now, or no?
On the IT specifically? Or
yeah.
So on the IT, it will come through as a new audit, so it will be on my work plan.
In terms of the other employee expenses, the compliance testing that I did on this one, again, it will come through as a new audit in the future. I'm just not following up on these recommendations because they've all been implemented. So.
Right. Okay, thank you.
Okay, those are all the questions, so we can move on to the last section.
All right, so the finance status update relates to the staff in your office. The original audit was a review of the organizational structure and resourcing within the Office of Mayor and Council to examine whether the structure and the role assignment was meeting the council needs at that time. So at the time, and I believe it still applies today, council desired more proactive support to help them with public outreach activities. The review found that there wasn't enough staff capacity to do this and still complete the required administrative tasks. It was recommended that staff submit an issue paper to obtain another part-time constituency assistant and then develop a mandate and strategy to help deliver more proactive service to council. This included empowering staff to anticipate council needs rather than waiting to be asked to complete a task. One of the two completed recommendations was related to submitting the issue paper for more staff. Unfortunately, due to other budget priorities at that time, the request was denied. Therefore, the other recommendations related to the strategy and empowerment have not been started as they depend on having more capacity. 3 of the recommendations are no longer required as they related to training around the previous tracking system called ACR and communicating new roles to council. Despite not moving forward on the proactive model, there were 2 other process improvements which have occurred since that time, which have had a marginal impact on improving capacity. So first, the legacy CRM system that was used for call and issue tracking was replaced by Lagan. Previously, staff had to manually create reports quarterly from the system to share with council about issues and trends in their wards. Now the reports are generated automatically on a monthly basis, which means staff spend less time on this task and council receives the more timely information. Second, an automated attendant was added to the main phone line and after-hours support through the corporate contact center was introduced. While there hasn't been significant drop in the amount of time that staff are spending on the phone with constituents because the more difficult calls are still being transferred here, there has been an improvement in customer service after hours as citizens will speak with a live person rather than getting voicemail. There is no further follow-up required on this audit. However, I know this topic is being looked at by your Chief of Staff to determine how best to meet your needs. A co-op student has been in place since April, as you know, which has provided capacity to provide additional proactive, high-value support to council in the short term. And this will be evaluated to determine future staffing needs. Are there any questions?
There are. Councillor Singh.
Yes, thank you, Mr. Mayor. And I'm glad that a comprehensive review was done of the Mayor Council office. I personally have felt that there are shortfalls as being a member of council who has other professional considerations on top of my role as a councillor, which is at this point still considered as a part-time position. The review that was done, was it part of past term of council or was it in this new term of council?
Just check the date, 1 sec. I think it was the past term of council. The audit was completed in June 2015.
Oh, June 2015, so that's some time back. So the information that's being provided to us at this point based on certain recommendations or actions or inactions that have been taken, is that with the outlook of the new makeup of council, which there are now 3 new members of council who have replaced members that council seem to be their only their focus, while the 3 new members of council have, like myself, other professional considerations as well. Have we factored that into what we're looking at as we look forward in what the makeup of the mayor and council staff contingent should be based on what the needs are now?
Ms. Robb, you wanted to respond to that one?
Sure, thank you. Through you, Mayor Urbanovic, to Councillor Singh. As you're aware, Paul has been doing a secondary comprehensive assessment of the model in Mayor and Council. He did request meetings, I believe, with all of council members, so if he hasn't spoken to you yet, there will be an opportunity to do that, but it was exactly with that intent in mind, to look at the new makeup of council, the needs of this council as it sits today, and compare against the resources in the office as it is.
And when would either that report or recommendations from that review be available for this with this new term of council?
So I haven't seen the summary of it yet. It is due to me from Paul by the end of the month. So in addition to speaking to all of you, he was looking at other constituency assistant models at other offices as similar comparisons and doing some research with the co-op student that's in the office now to prepare a case for me. So I haven't seen the results of that, but it should be coming soon.
But a report is coming?
Yes.
And that report will be made available to council as well?
Yes, it will.
Perfect, thank you.
Okay, those look like they're all the questions.
All right, that's it from me then. Thank you.
Wonderful, and there is no motion required for this, so we'll move on then to item number 2. Audit services. And who's bringing that forward? Sorry? Who from? Mr. Lautenbach, okay, go ahead.
So through the chair, there's no presentation related to this report. Essentially, it's just establishing the auditor again for the next 5-year term. We conducted an RFP, and the results are indicated in the recommendation to award to KPMG.
Okay, thank you. Councillor Gazzola, you have a question?
Yes, I do.
Okay, go ahead.
How many years have KPMG been our auditors?
We're doing some number crunching.
Well, I'll leave it. Perhaps we...
No, Steph will have an answer for you.
Yes, through the chair. They have completed 2 5-year terms with us at this point.
Did they take over after Ernst & Young? Was there anybody in between?
Through the chair, Roger's telling me yes. It was before my time here, and Dan was giving me a look as well. I can come back with you with the numbers because I'm thinking they were here for 2 5-year terms, but Mr. Chapman's telling me it could have been 3 5-year terms.
Okay, so they've been here at least 10 years, and now we're looking at a total of 15 years. Further, I'm surprised at that we didn't get any response from what I consider the big 4 accounting firms, from Ernst & Young and Price Waterhouse and Deloitte. Is there any indication of why that's the case?
Mr. Lautenbach?
Through the chair, there isn't any indication of why they didn't decide to bid on this. It was an RFP, it was advertised. There are certain firms, obviously, look at where they want to specialize, and we had 3 responses from the ones that were listed here. We don't know the reasons why certain firms might apply to an RFP or not, but the indication would be it was widely advertised, so they would have known that the RFP was on the street.
These, thank you. These dollar figures that are provided, those are for the 5 years of service, or are those the annual fees? I've been away from it for a while.
Through the chair, that's for the 5-year term.
It's for the full 5-year term, then. So I can sort of divide it by 5, those figures? Is that correct? Yeah?
It would be broken down by the various parties, the costs associated with, but typically...
Okay,
I think just to answer his question, though, there was, if I remember, an inflationary figure built in, right? So it's not a pure divide by 5.
It's close enough.
Yeah.
That's okay. All right, fine. The other, just a reminder, does everybody share in those costs? Like there's Kitchener, there used to be a time when like Kitchener used gas, water, all the enterprises shared in that cost. Is that still the case? Or? I hope it is.
Through the chair, yes, that's correct. So it is broken down by the various areas as part of that.
Yeah, okay, thank you.
Okay, those appear to be all the questions. Councillor Galloway-Seelock?
I'll move it.
Okay, thank you. All those in favor? Opposed? That's carried. Motion to adjourn. Councillor Galloway-Seelock, Councillor Johnson, all those in favor? Opposed? That's carried. And we'll resume at 5 o'clock in the caucus room.